What's going on, everybody? Cullen Gandy here, coming at you with another video about personal finance, mortgage finance, basically anything to help you get down the road financially to where you want to be. Today I want to address a subject that has been sort of requested by a lot of people nowadays, since we are coming to the end of this sort of stay-at-home order that a lot of people have been on the past year. And that is the question of how you protect your money and your investments in a period where you think that there's going to be a lot of monetary inflation. Now, as some of you may know, if you follow the Wall Street Journal or watch the news, or maybe even just some other finance channels on YouTube, much of the current supply of US dollars that is in circulation today was in fact printed in the past year alone. In fact, I think the figure is as high as about 25%, so one full quarter of the amount of dollars that exists in circulation was printed in 2020 to 2021. Now, I know that most of us have taken high school economics, and that you know that if there is a lot more money but the same amount of stuff, that the value of the dollar tends to go down, right? That's the principle of scarcity with other goods and services. The more of it, the more less valuable it becomes. So in this video, I want to give you some very simple ways that you can either just protect the money that you have invested now, or the wealth that you've accrued up till now, or even perhaps profit from the prospect of there being a lot of monetary inflation. Now, to understand how we can protect against possible inflation in the future, we have to understand first how it is calculated, and that is through two particular indices: the Consumer Price Index, which I will be really talking about a lot in this video, as well as the Producer Price Index on the opposite side of the economic scale. The Consumer Price Index is basically an assessment that is done on what the actual cost of a parcel or a basket of certain goods and services are relative to the amount of money or dollars that it would take to purchase that. So that's kind of a long way of saying how much money can you get by selling somebody a certain amount of stuff, or how much money would it take to buy a certain amount of stuff. Now, if you want to capitalize on the fact that the goods and the services that are calculated in the Consumer Price Index are going to become essentially more valuable relative to the dollar, then it goes to follow that you're going to want to invest heavily, or at least more heavily than currently, in actual goods and services, or tangible assets and commodities. Now, the first thing I want to talk about, and that's something that I'm fairly familiar with, being both a person who went to university and in the mortgage lending industry, and that is the value of debt. It is really important to understand, especially if you have a home that you have just gotten, a loan out on or refinanced into, or if you're paying down on your student loans, that the amount of debt that you hold currently going into a period of inflation becomes a lot more valuable. Why is that? Well, in the case of a 30-year fixed-rate home mortgage, the amount of money that you paid for that home is static. It'll never change, it only becomes less over time. And the interest rate that you pay on that money, which right now is among the lowest that we've ever seen in the US economy ever. A lot of times right now I'm quoting people, really qualified people, for 2.75, so that's, outrageous. To put it really simply, in a period of inflation, money becomes more plentiful and less valuable, but debt remains the same. So if you service debt because you're getting paid more money and because more money is available, then essentially the value of the debt increases. Why? Because the amount of money relative to the debt when you got it at the time becomes much, much easier to attain. If you got $100,000 when $1 was really hard to get, and then you go into a period where it's a lot easier to get $3 every now and again instead of just the $1 for the same amount of work, then that initial $100,000 becomes a lot more valuable to you as debt, because you can pay it down with the same amount of work as it used to take you to get $1 to now get $3. Another way that I plan on sort of mixing it up for an inflationary economy is to hold on to any sort of tangible assets that I think are going to be valuable in the future. So if you have a chance between having a loaf of bread, let's say, and a dollar that is becoming less and less valuable, so it would take more dollars to get the one loaf of bread, then in a period of high inflation, it's always beneficial to just hold on to the bread itself, because when the period of inflation is over, you're going to keep the same amount of value that you had for the piece of bread, but you're going to get a lot more dollars in. So one of these commodities and tangible investments that a lot of people like to make when there's inflation, in fact, great amounts of inflation, is in commodities. That is to say, gold, silver, crude oil, things of that nature. Because those are things that have inelastic demand. They're highly what's called illiquid. That means that you can't easily convert them from one form, let's say the gold, into money. You'd have to sort of transact on that. And so they hold their value over time fairly well. This is an important distinction to have between how much something costs and how much value something is. Because if people prize a commodity or a thing as being valuable, even though the amount of money in circulation may change, it's always going to adjust towards how much people think that thing is valuable. So if the dollar relative to a parcel of gold right now is set, let's say in 2020, and becomes $3 or $4 or $5, it's going to retain the value of whatever it was at the beginning. One great way to capitalize on this right now, and another way to segue into my career as a mortgage loan originator, is to get your hands on some real estate. And this is a really hard call to make right now because in the real estate market, inventory is historically low and prices are incredibly high, the highest that a lot of places have ever seen for a new family home or townhouse or condominium. But on the back end of that, we are seeing some of the lowest interest rates that we've ever seen in the economy, as I said early. So that's kind of what spurred on this great amount of purchasing power that's going on for homes. And then if you're sort of a casual investor or you just want to make sure that your money is going to more or less hold value, more or less keep your investment stable over time, you're going to want to go into the bond market. That is to say that you want to invest in institutions or places or businesses that you believe are going to hold their value over time. Now, what are some of the bonds that people like to buy in a period of high inflation? Well, one of the most attractive options during a time of high inflation is a Treasury inflation protected security, or TIPS. TIPS is a kind of bond that the Treasury has created that is tied directly to the consumer price index. And that way, when inflation inevitably comes, it is going to go up with the price of inflation. But not only that, because the bond is tied directly to the consumer price index, the principal or the initial investment that you make is always going to be protected because it's always going to have its value tied to what the initial investment was, regardless of how much inflation there seems to be, right? One other benefit of a TIPS or Treasury inflation protected security, say that 3 times fast, is that it pays interest every 6 months up until its maturity. Now you can buy these Treasury securities with different maturity dates. You can have a 5-year, a 10-year, even a 30-year maturity date. And at the end of the maturity of your TIPS security, you will then get whatever the greater is between the principal money or the initial investment that you made or the principal plus the inflation, right? So if the balance at the end of that, let's say 5-year period, is the principal plus 3 or 4 or 5% inflation, right? And so you've made 3 or 4 or 5%, obviously that's what you get. However, if there is a period of deflation, worry not. And that's because you will be guaranteed that initial investment or that initial principal amount. You can get securities like those, that is, say, bonds like this, on the Treasury Direct system. So check that out as well. Another way that you can make sure you can protect your investment is just to go all out YOLO, buy all of the Bitcoin that you can, and just pray for the best. And if that doesn't work, just go ahead and just do a YOLO on some Tesla call options. That never did me wrong, right? No, but seriously, guys, I hope some of these ideas were useful to you. Let me know if there's some of these that you haven't already started investing in. I want to make sure that a lot of your portfolios are stable. And for those of you that don't have portfolios, at least you know that these are the steps that you can take to sort of protect your little nest egg for the future. Thanks so much, guys. And if you enjoy informational and educational content like that, please go and be sure to hit that like button for me, as well as subscribe and the notification bell. It would really help out with the YouTube algorithm a lot, and I would appreciate it. I need your acceptance. Take care, guys. See you in the next one.